Your money-making broadcast starts now. Markets closed mixed today in a session that will be remembered as the calm before the storm. The S&P 500, tracked by the SPY, edged down 0.1% to close at $741.25, with traders holding their breath ahead of what turned out to be the most consequential earnings report of the year. The Nasdaq 100, tracked by the QQQ, slipped 0.2% to $713.15 as investors hedged their technology exposure heading into the semiconductor earnings event. The Dow Jones Industrial Average bucked the trend, gaining 0.7% to close at $500.24, supported by financial and industrial components, while the small-cap Russell 2000 fell 1% to $279.87, reflecting a cautious rotation away from riskier names. Today marks day 30 of the current bull market cycle, with the S&P 500 still trading near its 52-week high and the RSI hovering around 68, just 2 points shy of the overbought threshold. But the headline numbers tell only part of the story. What happened after the closing bell has fundamentally changed the market narrative for tomorrow and beyond. The leading artificial intelligence semiconductor company delivered a revenue beat, raised forward guidance, and announced an $80 billion share buyback program that has sent after-hours trading into a frenzy. At the same time, the market is counting down to the Kevin Warsh Federal Reserve transition on Friday. A Bank of America bull capitulation signal is flashing a contrarian warning, and Berkshire Hathaway has revealed a massive new position in Delta Airlines. These four developments define the current investing landscape, and each one carries a distinct message for where markets are headed next. Let us begin with the single biggest story of the day and arguably of the entire quarter. The leading artificial intelligence semiconductor company reported earnings after the closing bell, and the numbers were nothing short of extraordinary. Revenue came in above consensus expectations, forward guidance was raised meaningfully, and the board authorized an $80 billion share buyback program that signals extreme confidence in the company's future cash flow generation. The stock closed the regular session at $223.47, down 5.4%, in what analysts are calling a classic positioning sell-off ahead of the print. Institutions were clearly hedging their exposure, and retail traders were bracing for disappointment. But the after-hours reaction tells a completely different story. The stock has surged on the earnings beat, confirming that artificial intelligence demand remains red-hot and that the CapEx cycle among major cloud providers is still accelerating. For the broader market, this earnings report does more than just validate the AI trade. It changes the entire narrative for tomorrow's session. The semiconductor sector broadly stands to benefit, and suppliers and beneficiaries across the artificial intelligence supply chain are likely to see positive spillover effects. If the stock opens in the $230 to $240 range tomorrow, as current after-hours action suggests, that represents a meaningful validation of the AI investment thesis and a powerful catalyst for the entire technology complex. Now, let us examine the second defining event of the week. Kevin Warsh is set to be inaugurated as the next chair of the Federal Reserve this Friday, May 22, and the market is already pricing in the implications of this leadership transition. The bond market has been volatile, with the 10-year Treasury yield oscillating as traders struggle to agree on the path of monetary policy under new leadership. The fundamental debate dividing economic circles is straightforward but unresolved. Ed Yardeni, the veteran market strategist, is publicly calling for a July rate hike, arguing that the Federal Reserve is falling dangerously behind the curve on inflation. His case is built on a second-quarter inflation forecast of 6%, which would represent a significant acceleration from current levels. On the other side, Treasury Secretary Scott Bessent continues to advocate the disinflation narrative, pointing to falling oil prices below $100 as evidence that price pressures are cooling. The reality is that both forces are operating simultaneously. Inflation at 6% would normally demand a hawkish response from a new Fed chair, but the drop in oil prices introduces a genuine cross-current that complicates the policy outlook. For equity investors, the Warsh transition represents a binary event. A hawkish inaugural statement could compress growth stock valuations across the board. A measured, data-dependent tone could fuel a relief rally. Between now and Friday, expect positioning flows and volatility to remain elevated. The third major development comes from Bank of America, which has issued what is known as a bull capitulation signal. This is a contrarian indicator that fires when large amounts of money rotate from cash and money market funds into equities. The logic is simple but powerful. When everyone has already moved their money into stocks, there is no one left to buy, and the market becomes vulnerable to a pullback. The father of value investing, Benjamin Graham, would recognize this pattern immediately. He taught that the market is a pendulum that swings between fear and greed, and the intelligent investor buys when others are fearful and sells when others are greedy. The bull capitulation signal suggests that greed is now in control, and that is precisely when a disciplined investor should be exercising caution. The legendary growth stock investor, Phil Fisher, would add another layer to this analysis. He believed in using what he called the scuttlebutt method, going beyond headline numbers to understand what is really happening beneath the surface. When Fisher saw a crowded trade, he looked for the overlooked opportunities in the forgotten corners of the market. The everyday investor's champion, Peter Lynch, would remind us that the best opportunities are often hiding in plain sight. He famously said that investors should buy what they know, and that 10 baggers are often found in the most ordinary businesses. And the disruptive innovation expert, Cathie Wood, would argue that the real opportunity lies in identifying the S-curve of technological adoption before the mainstream catches on. Now, let us turn to Berkshire Hathaway's latest portfolio moves, which were revealed in the Q1 13F filing and represent a fascinating insight into Warren Buffett's thinking. The most striking revelation is a $2.6 billion stake in Delta Air Lines, a stunning reversal of Berkshire's pandemic-era exit from the airline sector. This is not a small position for Buffett. It signals that he sees compelling value in the travel recovery story and believes that the airline industry's post-pandemic restructuring has created durable competitive advantages. Even more striking is Berkshire's 224% increase in its Alphabet stake. Buffett, who historically avoided technology stocks, is now doubling down on one of the most dominant companies in the digital economy. Together, these two moves paint a picture of a value investor finding opportunity in both traditional and technology sectors. The travel recovery and big tech are both attractively priced in his view, and he is putting significant capital behind that conviction. Adding another layer to the positive sentiment, OpenAI has won its legal battle against Elon Musk, removing a significant overhang and paving the way for a potential initial public offering. This is a meaningful tailwind for the artificial intelligence sector as a whole. An OpenAI IPO would be one of the most anticipated public offerings in history and would likely provide a valuation benchmark for the entire AI ecosystem. The legal resolution removes uncertainty and allows the company to focus on growth and commercialization. The Java's analytical framework synthesizes these 5 developments into a coherent market outlook. On the short-term horizon of 1 to 2 weeks, the nvidia earnings catalyst is powerful enough to keep the bull market alive. The QQQ could challenge its all-time highs as the AI trade reaccelerates. The after-hours momentum is real, and the confirmation of AI demand validates the most important growth narrative in the market. However, on the medium-term horizon of 1 to 3 months, the risks are more concerning. Inflation at 6% in the second quarter, combined with a new Federal Reserve chair who may feel pressure to establish his hawkish credentials, creates a genuine correction risk. The Bank of America bull capitulation signal adds a layer of sobering evidence that the easy money may have already been made. Let us now turn to the Java's portfolio strategy for navigating these crosscurrents. The current cash position of 73% is excessively defensive given the NVIDIA catalyst. The model recommends reducing cash to 40 to 50%, deploying capital into high-conviction positions that align with the confirmed AI demand theme and the broader economic recovery. On NVIDIA specifically, the model assigns a conditional buy rating with 75% confidence. If the stock opens between $230 and $240, that represents a reasonable entry point given the after-hours confirmation of the earnings beat. If it opens above $240, the model recommends holding existing positions but not chasing the gap up. Patience remains a virtue even in the face of positive news. He understood that the analysis of price and value is the foundation of sound investing, and that applies directly to the current environment where the bull capitulation signal demands disciplined evaluation of every position. He would remind us that the intelligent investor is not one who merely forecasts correctly, but one who understands the difference between price and value and acts only when the margin of safety is adequate. Drawing from his framework, the first recommendation is Pfizer at $25.87. This pharmaceutical giant offers defensive exposure with a robust pipeline, strong dividend yield, and non-discretionary healthcare demand that persists regardless of the economic cycle. Pfizer is the kind of bedrock holding that provides portfolio stability during periods of policy uncertainty, and the current valuation offers a sufficient margin of safety for conservative investors. He would emphasize the importance of competitive moats and management quality in identifying companies that can compound value over the long term. Following his principles, the second recommendation is Cisco Systems at approximately $99. Cisco represents balanced growth exposure with a strong networking and cybersecurity franchise. As enterprises continue to invest in digital infrastructure and network upgrades, Cisco benefits from secular demand that is independent of the broader economic cycle. The company's transition toward recurring software revenue and its leadership in secure networking provide the kind of competitive advantage that makes a stock suitable for balanced portfolios. He would tell us to invest in what we understand and to look for the hidden gems in everyday life. Applying his approach, the third recommendation is Carnival Cruise Lines at $26.03. The summer travel season is approaching, and the cruise industry continues to benefit from pent-up demand for experiential travel. Carnival has been successfully reducing its debt load and improving its operational efficiency. While the stock carries higher volatility, the underlying demand for cruise vacations remains strong, and the current valuation does not fully reflect the potential upside from peak season performance. She would argue that the real opportunity lies in identifying disruptive trends before they become consensus, and that means looking at industries where technological transformation is accelerating. From her perspective, the fourth recommendation is Ford Motor Company at approximately $13. Ford is undergoing a significant transformation toward electric vehicles and commercial mobility solutions. The company's commercial vehicle business provides a stable revenue base, while its electric vehicle investments position it for future growth. At $13, the stock offers accessible entry for investors who want exposure to the automotive technology transition at a reasonable valuation. These four recommendations reflect the Jarvis methodology of combining safety, growth, innovation, and value across different risk profiles. The immediate catalyst from the artificial intelligence earnings report provides a short-term bullish tailwind, but the medium-term risks from inflation and monetary policy transition require disciplined position sizing and risk management. Reducing cash from 73% to 40 to 50% captures the near-term opportunity while maintaining sufficient reserves for the correction that may arrive in the coming months. As always, conduct your own research and invest according to your personal risk tolerance and financial goals. I'm Chloe. See you at 7 a.m. Eastern for shorts. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.